Good morning, good Friday morning. I'm watching you streaming. Let's make sure that this is visible. I have a feeling it might not be because there's so few people. Or people might still be in holiday mode. Buenos días. So today I do not have Wi-Fi, so I think we will be okay though. I'm gonna use my Adobe Pro software and see if I can annotate the notes as we go along. It should be fine. Most of the things are in the notes. I even prematurely added a few things. Preemptively, let's say. Good morning. So, I promised that whatever we finish today will be the stopping point for the test next week. I gave you a ton of material. Most of it are review exercises. And you get to use them when you write the test, right? You also have a long time. I'm giving you a lot of time, Saturday and Sunday, to write the test, so you'll be studying as you go, I guess. So that means that I can ask more of you, and I'm going to push through right now so that we do get a bunch of material completed before the test, because I'm thinking that the final test will not be cumulative in the way that I'm not going to ask you stuff that we did back to chapter 2 directly, but you need those tools to answer the final test, okay? So it'll be more, the final test will be more based on what we do after this test. So as much as we can stick in this test, we can focus on the last part for the final test. So you can share that information with your classmates. I have the TA working on the timestamps for the videos, and we're working together. He's watching and he's making notes, and you can see those timestamps, and that can help you review all the videos, okay? And I just need to put headings in so you can be oriented through the videos and navigate easily. All right, good morning. So we're going to pick up where we left off. I left you for a while with just that one review document and without the answers, and I hope you took the opportunity, or you realized that, or you found the solutions, okay, so that you solve them yourself and then you compared against what I gave you. That is my wish or my hope. And now with this, what we're going to do next, you're just going to continue with your review to the test date. Okay, so what did we do? We talked about using statistics for finance. I gave you a data set, and we summarized statistics on a very small data set. This was just a volatile time in history from 2007 to 2010, and I used the example to illustrate the importance of using the right statistics to characterize data. So I hope you sat and tried to replicate these calculations yourself, because it's much more meaningful if you try this yourself. Often students make the error with this negative here, so it's good to practice. All right, so you would write this out and then simplify before multiplying the values to get this one. Similarly down here. Okay, so from this conclusion, we concluded that a negative holding period return over time means that if someone was invested just over that period of time in the stock market, reflected, the performance reflected in this index, you would have lost money, okay? So you would have lost money, and then on average, every year you would have lost this much for a total of this much here, 3.3% negative return. And I compare those numbers against the arithmetic average, and we said that that's not, if there's a difference between geometric and arithmetic average, we go with the geometric because that is not sensitive to extreme values. Remembering that we only use arithmetic average when data are symmetric, and this data set is hardly that. It's very scattered and flat if you were to plot it, graph it. All right, so that's just saying, continuing or recapping where we left off last time. Do you have any comments? So this is the risk and return document. Let me tell you which number it is to be sure. Yeah, 5.9. Okay, this is document 5.9. So we're going to finish document 5.9, and then I will see if you have any pressing questions about the homework exercises I sent. And then we will get into the next set of PDFs. All right, so that was, and we just applied statistics to summarize the expected value, what to expect if you were an investor during this time frame. You expected a return that is negative of about 1% loss every year, okay? And if you remember back to statistics, our review, we don't usually, in statistics, simply have an expected value. To capture the distribution of values, we present a second statistic known as standard deviation when the data are symmetric, or some other measure when they're skewed. So what we're going to do here is we're going to stick with the standard deviation, just as a measure of what is volatility, okay? So here we have an illustration, and I'm going to summarize this data with some graphical distributions at the end. But here you have the data on returns to, what did I use? So each of these are different things. S&P 500 is the bold line, so that's the more wild. How can I do this? So that's this one here, right? So the one that's more wild is the S&P 500. And that reflects that you could see that the returns are can go as high as about 45% returns in a year. I guess these are annual returns, and as low as negative 40% returns, okay, throughout this period. Compare that with, so those, we think about that as those are risky assets that are a stock. The asset class that is less risky, so it has less volatility, you'll see in the returns over time, would be the example of that would be the 3-month Treasury bond. This is a government bond that is, we talked about Treasury bonds and T-bills when we were dealing with bonds, discount bonds, pure discount bonds. So you, as a bond holder, you buy the bond, and then you get your return on the bonds. You get the interest at the end of a period, in this case 3 months. So that would be this less volatile graph here. So it's not as wild in returns as the stock market. Right, so that's the least volatile. Then you have one that's a treasury bond, but it's a longer duration, and it's more volatile than the T-bill, okay? So these asset classes compared relatively, it's important to realize that the volatility, not just the return on average matters, not just the expected value, but how reliable is that expected value. Reliability is measured by variance and standard deviation. So let me see if you have any comments. I can only look at one screen at a time. Yeah, we're going to talk about that, Jennifer. Don't worry. Okay. Let me continue. Okay, so this is how we measure variance. Remember, this is just the variance formula, which you then take the square root to get the standard deviation. We know how to do this, right? All I've done different than what you do in statistics is I used an R for return. Okay, so this is the regular variance and standard deviation. The symbol here, rather than S, you could use a sigma hat. Okay, but it's the same thing, essentially the same thing. So you can calculate that. You know how to do that. If I was to go back here using this data and your calculator, can you guys tell me, can you punch into the calculator the standard deviation? Now, I don't have Wi-Fi, as I mentioned at the beginning, so I can't do this on my calculator and transmit it. So try it for me and tell me. Let's wait till about 5, well, let's say 10 of you can confirm this value here. Can you confirm that the standard deviation is this much? Okay, I'll wait for you. So plug these in and find the standard deviation, sample standard deviation. Tell me what you get. Great. Okay, so now you know where that comes from. Okay, so use your calculator and you can get those values. On a test, unless I ask you to show your work, you don't have to show all this. Only if I say show work. And as I suggested before, with the ex ante and ex post returns questions, it's better to do columns. Use columns like you would in Excel rather than writing it on a line. Oops. Use columns. I should probably be typing with my typewriter here. Okay, I'm going to do that from now on. Okay, so most of you got that value, 27. It's very high, right? So what does it mean, 27? Oh, here are the steps if you want to do the table method as well. Okay, so that's just for you to practice. If you want to do it by hand, here's the columns. Do it in columns like Excel would. Okay, columns, columns, columns. Then remember to divide by one less because of degrees of freedom that we talked about way back in the stats review. Okay. So what does it mean? What does it mean? We got a mean of expected value of 7. What's this? No, that's not it. An expected value of 2.5 if you use the arithmetic average, and the standard deviation of this percentage. This is also a percentage, by the way. All right, now we're not going to use those to do what I want to do next because, again, I already showed you that this is not such a good measure of the data, right? It wasn't a good expected value because the geometric return was different. And that means the data is not symmetric, so to speak. So instead, what we're going to do is I'm going to draw my conclusions on page 11 like Jennifer wants to see. Oops. Okay, so let's solve this for something else. Let's look at, in fact, if you take returns on the stock market over a long period of time. So I'm taking 1928 to 2016, and this is actual data. I put the links to where I got the data to make these calculations. But look at this. This is the mean, on average, annual average returns to investing in the stock market captured in the measure of the S&P 500 over this 80-year period. What is that again? I always forget. This is almost 90 years, okay? So it's a long period of time. And that's the standard deviation. Similar, well, not similar, because this one is really high. It's not like 2%. So that those bad 4 years, that was a snapshot in time, the 4 years that we calculated the mean standard deviation for. But on average, over time, if you invest your money in the stock market, it looks like on average, if you leave it there over a lifetime, 88 years, it goes up. The stock market on average, even though it's volatile, the returns go up over time. Okay, that looks terrible. Let me write it with my typewriter. Hold on. You can see that. Okay, so what does it mean? Can you guys tell me? Well, if we assume returns are normally distributed, we can draw conclusions. We can say on average the returns are 11.4% and put it in the middle here. And then at 1 standard deviation from the mean, so where it's, remember I told you where it starts to curve up is 1 standard deviation. And here, so if you guys can draw it on your paper, that will be helpful. So within 1 standard deviation, what would that be? Here and here. And then within 2 standard deviations. And then within 3 standard deviations. So fill in this whole chart, curve. For me. And give me the values. And then we'll do the interpretation together. So you saw problems like this in the exercises I gave you, but maybe you didn't recognize what you were supposed to do. So 12% is amazing. What can you get in the bank right now? You can get 1% in your bank deposit. 12%, I'm saying 11%, 11.4% is quite good. Now I'm not giving any investment advice here, okay, because the market is volatile. But over 88 years, it looks like the stock market on average, if you put money in there and you left it, it went up 11% on average a year. So some years it did better, some years it did worse, but on average it was 11%. Yes, you can get this in you can get this sort of analysis, sure, in finance software. But it's really important to know what the software is doing, and that's why you're learning this, right? This is inside the black box. This is what it's giving you. It's using information like this, that returns on average, returns over time on the stock market are normally distributed. That's really important. So what you're doing right now is calculating those values. You're going to calculate. So what you're going to put here, I'll put in, this will be 11.4 plus 19.7 equals. And then here, you're going to put 11.4 minus 19.7. Where did I get this from? This is what you learn in statistics, right? This is the normal distribution. So within 1 standard deviation, what's the situation? So you have a 68% chance, if you're invested in the stock market over this period of time. Don't get confused with the percentage up here and the percentage down here, right? This is about the probability of returns. Probability, let's say, I'll just say the word probability. And these down here are the returns, okay? The units are percentages, so don't get confused. Try not to get confused. So what's my lower bound and what's my upper bound? Oh, you did them all. So let's just go for the first two. So Von Mari, I'm so bad with saying your name, I'm so sorry. At negative 8.3 and 31.1. It looks good. So this is negative 8.3% Okay, now I want someone to tell me what that means. Give me an interpretation in words. Someone give me the interpretation in words of what we just found in one standard deviation. You can say it in Spanish, of course. Okay, so there's a 68% chance of getting returns between negative 8.3 and 31.1. Very good. So there's a good chance you get negative returns, right? 68%, that's 70% chance. That's really high that you could dip into a negative. On the other hand, you could get as high as 31%. So it just gives you an idea that negative returns are possible. I say likely, 70% is pretty high, or 68% is pretty high. So let's do the next bit. You can write them all in. You can copy what the others did or keep making calculations yourself so you can practice. Okay, then, so this will be negative 28. So I take another, there's no room, I didn't give enough room, so let's see. I'm going to take negative 8.3 minus, again, 19.7 to get this value. And that's going to be 28. Okay, so that's going to be negative 28 here. And then over here, you're going to take 31.1 plus 19.7. And you're going to get 50.8. You can put it here. And then finally, 3 standard deviations, which I didn't mark. This is going to be very high. $70.5. You get the point. I'm just trying to complete this. And then over here, it's going to be negative 39. No, it'll be wow, very high, right? Negative 47.7. All right, so we know the chance of returns between negative 28 and 50.8 is 95%. So I'll mark that. What happened here? I picked the wrong thing. That's what happened. All right, struggling with my tools. Just want the pencil. Give me the pencil. Okay, so that's 95% chance. And then 3 standard deviations. So you're sure to get, 95% is pretty sure that you're going to have between negative 28% and 50.8%. So if you can't tolerate losing 28% in a year, that's probably not where you want to be investing. Now, is there a chance? What's the chance? So if I said to you, oh, I did ask the question, what is the chance of positive returns? So how would you figure that out? Now, honestly, approximate the best you can. What's the chance of positive returns? Did anybody know how to figure that out? So positive start. So somewhere in between here and here. I wish I had another color. I don't know how to change the color. So somewhere in here is the 0, right? Between 8.3 negative and 11. So half of the whole thing is 50%. If I cut this in half, so, and between 11.4 and 8.3 negative, right, between, if it's 68 total, then half would be like 34. Are you with me so far? So if you said anything like %, or 70%, you would have to add okay, so you add 30. I mean, I'm not being precise, but you could do this by standardizing and using a table. You could do this, right? You remember how to do that in statistics, but just approximately, I'm going to throw it out there. You can do it in Excel as well. I'll just say 30%. Well, I'll put 34 so you know what I'm talking about. So about 80%. So there's about 80% chance of having positive returns. That's really important, right? So it's a good chance you're going to have positive returns, but you have to tolerate the chance you might have negative returns. You with me? Yeah, or you can just say more than 50, exactly. I'm just saying halfway, just to give you an idea. It's not balanced. You could do this in Excel, but I'm not expecting that for this course. But you could go to Excel. I don't want to open Excel again because it's a it's a rabbit hole. I get lost in Excel. Well, I mean, there's so much to do there. Anyway, but just an approximation. If you had to choose between options, draw the picture and show me it's about 80%, 75%, 70%, I would be fine with all those answers. More than 50% is fine too, like Jennifer said. Okay, because this definitely is not even. Yes, Tiana, that's right. So more than 50 would be a fine answer too. I'll put it in here. But less than, you'd have to say less than. Like, you couldn't just say more than, because then you could say it's 100, right? So these are all acceptable answers. Okay, so you guys better with that now? So you have the tools to answer that. You already had the tools. It's just maybe you weren't confident about what to do with the numbers. Okay, what is the chance the returns will be less than negative 30? Does anybody know how to answer that? So I hope this is wrapping up all your questions about how to use statistics, why we use statistics, how to interpret for returns data, okay? If you're looking at the stock market, this is how you do it. Okay, so this is good, very good. That's right. The other way, Jennifer, you're looking the wrong way. Okay, let me show you. You guys are all, well, some of you got it right, but dancing around. So the 30 is around here. So let's just use that, okay? It's negative 28%. That's pretty good. That's pretty close to 30. So what is less than that? What is less than that? Oh, I'm not going to be able to draw. What is less than that? What is the area here? Well, remember I told you that's 95% in between, right? So that means inside is 95, outside is 5. But you have 5% over here and 5%. Sorry, we have 5% total on both sides. On this side, and let's draw this side over here. On this side, right? Because the inside is 95, the outside is 5. There's half goes on this side and half on the other side. All right, so this side must be 2.5%. So there's a very small chance of having less than 30% returns. So the answer is about 2.5% chance. Got it? Good. So it's an outlier. No, it's not an outlier, sorry. Where are the outliers? What's a real rare possibility would be outside 3 standard deviations. 3 standard deviations would be, okay, let's just write it in words so it's not a mess. Outliers are outside negative 47.7%. I'll make an interval thing, and 70.5%. So the chance of getting values out there, oops, very rare. And what is the chance of an outlier? Um, 0.3% chance of being outside that interval. Okay. Questions? Yes, you can say that, Ariel. Less than 2.5, sure. I said about 2.5, but yeah, less than 2.5 is for sure. I'll write it as an option. All right, can I move on? You guys get this? Now that is the extent of it. If you wanted the exact values, you could use Excel to calculate the exact values. The assumption is that we have assumed normal returns, okay? That returns have normal behavior in order to do any of this. So we see, if we look at data, now this is from, this is some data just over a shorter period of time. You see about the same thing, right? I think this is from the textbook that I was using before, where you had, it looks about the same, 11.7 on average, and 2.6% as a standard deviation. This is for large company stocks. So this would mimic something like the S&P 500. And these are big companies. And you see, it's not perfectly smooth and symmetric and perfectly smooth and normal, but it's an approximation to normal, okay? So this is approximately normal, and it's a normal, I mean, it's enough for them to say normal. It doesn't fill in, you don't fill in all the gaps, but it's what they would call approximately normal. And if you look at small company stocks, the returns on average are higher. However, the risk is greater when compared to large company stocks. So begin to see there's a trade-off. It looks like there's a trade-off between risk and return. And the way I'll interpret that is, say, the higher volatility as measured by the standard deviation, this is a measure then therefore of risk. The higher the risk, the higher the expected return. Otherwise, investors won't invest in it. Okay? This returns have to be compensated or assets won't exist in the market. Now, this is where we're heading with all of this. This property, this principle, is what we're going to use to help us determine the right required rate of return for a company to use in valuing projects, for investors to use in valuing firms, and so on. So here, as we go down, so what we have here, a long-term bond. So these are more stable, you see, low risk, but there's the catch, lower return. Long-term government bonds. Okay, so this goes against my principle a bit, but okay, this is higher risk, but the returns are about the same. Okay, so you could debate if in statistical terms these numbers are very different, but anyway, they're about the same level. And then these returns are about the same level. Are you with me still? Let me check the comments. I know I'm whispering. How many of you notice I'm whispering? Okay. I have the mic as close as possible so you can hear me. Okay. Let me save that. All right, so then we arrive at the T-bill. So the T-bill has, relatively speaking, the lowest risk when you compare to different asset classes of long-term government bonds, of corporate bonds, of small company stocks, of large company stocks. T-bills are the lowest risk, and so too they have the lowest returns. So why would you invest in them? Well, look at this, inflation. Inflation, the rate of inflation is 3.1%. So that erodes any kind of dollar savings that a person might have. So it's worthwhile, well, any rational investor would realize this and invest in something, invest in an asset that is that preserves purchasing power. And that's why we say rational investors will always invest in T-bills. Okay? That way they'll at least beat inflation and with low risk. So we actually go as far, and I'll tell you right now, we're going to call this, and in theory this becomes our risk-free asset. Even though there's volatility, we still refer to it as risk-free, and I'll teach you the implications of that. So we write it RF. You'll see that in the notes. R subscript F. Just because, relatively speaking, it is lowest risk. Okay, so what do we have to do here? What we have to do here now, comparing all of the other asset classes to T-bills is important. It's going to tell us exactly what is the premium for a premium required or expected by investors who are investing in anything other than T-bills. So for instance, let's start up here. So the risk premium to invest in large company stocks would be R. Well, let me put the simple thing here. So a risk premium is the return on whatever asset you're looking at minus the risk-free asset. I hope you can see that. So here you're going to take 11.7% minus the return on the risk-free asset and compute the risk premium. The risk premium is 11.7 7.9. Okay? So calculate these all the way down, and I'm going to talk about them. Tell me what they are. All right, so those are the risk premiums, and we talk about these in finance and refer to them. And in fact, when you look at portfolios or combinations of securities, the risk premium is very important, and it's used to measure the Sharpe ratio, which we'll talk about later. So you need to make that, know how to make that calculation, and in this case, it's relative to the risk-free assets that we calculate the premium. So investors in long-term debt, of government debt, require 2.3% risk premium. In long-term government bonds, they require 2.4%. In small company stocks, 12.6%, very high, and in large company stocks, 7.9. Questions? And you see the patterns here. These returns, let me get my pencil. These returns are lower. You see I have the 0 here. Okay, so these returns are, oh, these are off scale, isn't it? No, that's all right. I guess these are 0. So on average, notice 11.7% is the average up here. I don't have this scale very nicely, but the point is to compare them. You see that there's a lot going on higher than 0 over here. That's important. However, there's some negative returns too, creating volatility in that 20.6%. Okay, so I said enough about this page. Any comments? Okay. Let's go on. So this is just to do the same thing, but I use the data here that corresponds with the distribution that we drew, the normal distribution, the mean, the standard deviation, and the risk premium. And same pattern. I did these myself using that data set that's available through New York University Stern School. Okay? And you see the nice histogram, which investors will refer to as normal distribution here. And the returns are higher, you see? The peak is higher than the peak over here for government debt. That's the main point. Okay, so that's all I want to say about that. Any questions about that? Let's look at the I want to look at the homework. Any questions on the homework? Do you think you can do the homework now? Are there any questions that you have with the homework? Exercises. Well, remember that these measures are, I'm answering Tiana's question, why would anybody choose? If they were looking at this data, looks like my screen froze. One minute. Okay. If they were looking at this data and you're asking about the one page before. So right. So for this higher return and this lower risk, it doesn't make sense to invest in long-term government bonds versus corporate bonds, does it? It's just a matter of what you believe is going to happen in the future. It's a matter of what you believe is going to happen. I remember now why I did this. I wanted to use the data before the global financial crisis, or including the figures of the global financial crisis, so the 2008 year of the 34% loss in the S&P 500, and then take the data including those bad years and show you that it's a wash. Like, it didn't really change much, right? From the return of 11.7% to 11.7% return in the stock market measured by large company stock, and the 11.4% here is a slightly lower, because I'm not using the S&P and the other figure, but anyway, showing you that it washes out that effect, that on average those few years don't seem to matter. But the point is, even though these are averages over time, you have to look at your immediate future. And if you believe the government is more reliable than corporations, at a point in time, you might go with the more secure government bond, because government commits to pay debt. And the way they guarantee that is they have the power to tax the public to repay bondholders. So that's greater power than any corporation has. So that would be the only rationale people would, if they just don't feel secure in the economy or in corporations or the private sector, and they choose government debt. Now that should be reflected in the standard deviation, but let's say you had old data, like this is 2008. I don't have the figures here for more recent data to compare. But my point is, this risk measure should capture all of that information about the past. However, this is historical data. Remember, it's not incorporating what you think about what's going to happen in the future. If it's very different from what happened in the past, these numbers have to be adjusted. You with me? You understand my answer, Tiana? But if this was all you had, and you had to make a decision based on this information and no other information, you are right that there's no rationale to invest in government debt. Okay, let's get to the next. Right. So the question was, nobody has any questions about the assignment. So just work on the questions in what I called .10. So you work on 5.10, and we're going on, I guess 5.11 has the answers. And I'm going to pick up with 5.12. So let me write that in the feed. Now, I sent you just this morning 5.12 revised. There was something missing in those notes that I want to talk about, so I added it in. So make sure you're opening the document called 5.12 revised. Let me make sure I have the right one. Yeah. Okay. So what I need to do, this one. All right, so this is going to seem fast for people who did not do the stats review or don't feel that they're up to date, because I'm going to assume you did those exercises, you practiced calculating mean standard deviations for both historical and ex-ante data. I'm going to use ex-ante data a lot here. Okay, historical and ex-ante data, or ex-ante and ex-post data. Okay, so what we learned is the relationship between risk and returns. It looks like as risk goes up, investors require or expect a higher return to take on additional risk, and that plays out in the market. So investments won't exist with the same level of risk. They have to have, or more risk, they'd have to have a higher return for investors to be willing to invest in them. Okay, so to make good or value maximizing financial decision, one must understand the relationship between risk and return. We accept the notion that investors like returns but dislike risk. We're going to use the measure of expected return for return, and the variance of returns, or standard deviation, as the measure of risk. Okay. Now this looks menacing, but you guys remember we did this already, right? This is the data for returns to a company called XYZ. These are the returns here, and here are their probabilities of getting this return given certain states of the world. So if there's a 1% change in the economy, which is pretty average, it's a little below average, I guess, this firm is going to lose, investors in this firm will lose 5%. 1 second, please. Take a break. Okay, I might be interrupted in a moment. Let me just continue, and we might take a break in a little bit. All right, so there's a loss, okay? So if you invest $1 over this period, you'd lose 5 cents for every dollar invested. There could be a more normal state where it's 2% change in the GNP of the economy. Now this would be positive for this company. The returns seem to mirror, or they're positively correlated with the economy, so that there's 15% return for this company. And this is like a more of a boom state, or above average returns for the economy. The chance of that happening is 25%, and the returns would be very high, right? 35% returns. So for every dollar invested, that's 35 cents return. So look at this. Don't be confused by all these percentages floating around, okay? This is talking about the economy doing poorly, normal, and well, and these are the probabilities of those happening, and I put those as decimals, whereas these are the returns to investors that I put in as percentages. All right? Okay, so we know how to calculate the mean and standard deviation of those. So in the next few pages, I'm going to show you those calculations, and you guys can use your Excel to confirm these calculations, or at least just follow along remembering for ex-ante returns, we need to calculate the weighted mean. The weighted mean, if you do all of this, will be 15%. Okay, so the 15%, which is more likely than the others, is stronger to outweigh the effects of this negative 5% and this 35. So on average, the returns to this to investors in this firm would be 15% next year. Questions? We'll see how far we get, Jennifer. The UR case goes along with the next set of notes, so probably not. But that's where we're headed, okay? Let's see where we get today. And standard deviation, we know how to do this, right? We have returns with the chance of having those returns given the probability of the state of the economy, and we calculate the weight standard deviation. So you guys should be able to do this as well with columns. Okay, you have the values here in the first column. Here you weigh them and multiply them. So now our investment in learning statistics should pay off, where you should be able to replicate these calculations. Calculating the standard deviation first, the variance, and then the square root of the variance is 14.14. So in conclusion, the returns to XYZ are on average 15% with a standard deviation of 14%. Did I miss a page? What happened? Okay. Any questions so far? So you should be able to make these calculations. All this notation you've already seen before. So if you need to review that later. Make sure you can get this calculation. All right. Questions before I go on? So what I just talked about was review. What I just talked about was review. And now I'm going to introduce something that we haven't talked about together yet, but you should have seen this in statistics. But if not, or you don't remember, have no fear, you can handle this. I'm positive of it. What we're going to do now is we're going to talk about two assets at a time, all right? Because usually investors don't just hold one security. We need to learn about portfolio of assets, combining several assets in one bundle called a portfolio. So we begin with two, and then I use some convincing to talk about more than two, all right? We keep it simple as possible. So here are the expected returns for two assets. Now, looking at this table, before you begin, with statistics, you should always graph to visualize data, but if you have just a little data, you can just stare at it. Stare at this data and tell me about the relationship between A and B. Can anyone tell me about the relationship between A and B? Nope. All right. notice with a 40% chance the economy will experience expansion, a boom. Asset A will do very well with 30% return. Asset B will do very poorly as A did well. If the economy goes bust, there's a 60% chance of that happening, that's higher, and returns to stock A or asset A will be a loss, 10% negative, but the returns on stock B will be even better, well, just as good as the 30% that asset A would have had in the boom economy. So it looks like, what do we call this relationship between the two assets? Come on, someone. It's a negative relationship. Excellent. So these are negatively correlated. You know that, right? Remember we talked about this? Now that I say it, so these are negatively correlated. So these are negatively correlated. When one does well, the other one does poorly, and vice versa. So let's first calculate the expected return on each of them. The expected return is a weighted mean. So the weighted mean, using these weights here for A, so there's only two possibilities. This is what we've done. We simplified things to two states of the world. Only two things are possible. Okay, either the boom or a bust. Weighted mean of that is 6% for stock A or asset A. For asset B, it's 7%. So on average, they do about as good as each other. So far it looks like B is better, but slightly better. So let's see what's next. What do we do next? Calculate the standard deviations to understand the volatility or the reliability of those measures, like how often or how likely we could expect 6% given the risk or volatility of the returns, or 7% for B given the volatility. So let's calculate the variance and then the standard deviation of each. You guys can practice doing this, and look what we got. It was 19.6% for asset A and 22% for asset B. So how do you put this together? You have asset A, which had 6% return. So let's put it down. I think I have it on the next page. So here's the conclusion. Asset A has 6% return with 19.6% standard deviation. Lower return, but lower risk. B has a higher return, but a higher risk. What should an investor do? Now, the answer is really a question. The first answer is a question. So what type of investor are we talking about? So there's a couple of things going on here. We have to think about the type of investor and how to put together these numbers in a meaningful way. That numbers that show this trade-off between risk and return. We like the return, but we don't like this risk. However, is it enough? Is this return enough to compensate for this level of risk? That's what we want to look at. So the way to look at that for risk investors, when presented with two securities with comparable return, they'll choose the lower risk security. So how would we put that together? we put that together in a measure known as the coefficient of variation. What we're doing is taking the risk level, so the 19.16% for asset A, and spreading it out over the good thing. So we're taking the bad thing, the risk, and we're spreading it over the good thing, the return. And that looks like the risk is, for every level, every unit of return, 3.27. Now this is an index. This is not a percent or anything. You read this like that, 3.27. Okay? And you compare it to doing the same thing over here. You take the risk, which you don't like, the 0.22% risk of B, and you spread it out the thing you do like. So for every unit of risk, for every unit of return, you get 3.14 units of risk. So that works out to an index of 3.14. So investors who don't like risk, they'll pick B over A, comparing 3.14 with 3.27 because it's lower. They like lower risk. Investors that are risk loving would pick A over B. Any questions? So this is really important. This is the new thing, coefficient of variation, spreading out risk over the benefit. It's a way to combine our statistics very efficiently. Can I continue? Okay. So all I've done so far is talked about two assets on their own, and I chose between them. And I gave you tips on how to choose one or the other, which is very important. So you should highlight, you should put a post-it note in these notes, or put a red marker or an asterisk. This is a very important page, okay? This is a conclusion of how to deal with the trade-off of risk and return in comparing two assets. However, usually investors don't compare just two assets. They combine assets and hold a portfolio of assets. And the question becomes, how do you choose assets to go in that portfolio? So we begin with two and we combine them. Now, how do we combine them? This is also slightly new, but you have all the tools to do this. Trust me, you have all the tools. What is this thing here? The expected return of a portfolio. Combining N securities in a portfolio P. So P right now will represent P for portfolio, okay? Combining securities, we still want to compute those statistics for them. So we want the mean and standard deviation of the portfolio. That's what we're going to do. So we begin with calculating the mean. It turns out that in a portfolio, in combining, we don't have to combine assets 50-50. That's what I do here in the example. I say there's two assets and I use, so for example, I have $100 to invest. $50 are invested of A and $50 of B. Now, it doesn't have to be that way. It doesn't have to be 50-50. You can invest in any ratio that you want. But this example, I'm going to do 50-50, okay? Now, how do you put these together? It turns out, now this is the important thing, that the average is here. So this is the average of 8. This was 6 and this was 7, remember? So this one was 6. Oh, I can't highlight. All right. So they had 6 and 7% returns. And now I want to combine them in a portfolio. So what I have to do, because I'm half invested in one and half in the other, it turns out I'm going to use the rule of means that says that the weighted average of means is what I want. So the way that you do this is you take the weight and you pre-multiply the weight by the return. I'll put the weight in brackets, distinguishing it. So they're all decimals, right? Because they're all percentages, but you just have to be clear. One is the weight, this is the percentage, this is XA. I should write that down. And this is XB. Now they're the same number, they don't have to be the same number. Questions? Yes, Tiana. CV combines both sets of information. CV, what we say, ratifies the problem with considering the trade-off. Maybe it's a long answer between risk and return. I'm just writing it in the feed. So when you put this together, it's just halfway between 6 and 5%, which Ariette correctly says is 6.5. Oh, I should put it down because it's nowhere. Okay, so then I think I know how to make this font bigger. Maybe I'll take a break and I'll do that. Let's take a break and I will fix this size of this font. Okay, let's take 5 minutes and I'll continue. All right, I'm back. Okay, so what we do next, let's see if you have any comments. I was unable to fix the font size, so that's what we're stuck with. All right, so we have the conclusion of that was that the weighted mean was 6.5. So you can write as a percentage or a decimal. And now this. What the heck is this, right? What is this? Can somebody tell me? This is one of the last formulas you're going to need for the class. This formula is important. Okay, one second. Sorry, someone just handed me water. All right, so this is like I said, one of the last formulas you're going to learn for this class. So let's learn it. Notice that the mean of two assets, so this is known in statistics as joint, you would remember it as joint probability. Or rules of means and variances. I'm not sure how you learned it. Okay, so rules of means and variances. The weighted mean, and this is the weighted standard deviation. That's what we want to go to, the weighted standard deviation of two assets. Now when you're joining two variables together, and those two variables are uncorrelated, there's no correlation between them, if they're uncorrelated, the formula for variance would just be, or the formula for standard deviation would look like the one for means. It would just be the weight. Now remembering, for the variance, we always have to square our values first, right? We did discuss that in class. But this part here would be the variance if the assets were uncorrelated. Just that part. So it looks like the weighted mean, but I have to square things first. I have to square the weight as well as square the standard deviation. Okay, so this is the weighted standard deviation if A and B were uncorrelated. But in our case, they're not. What did we observe at the beginning? We observed that they were negatively correlated. So because of that, we have this extra term. What is this extra term? It's 2 times the weights, in this case 50%, or 0.5 and 0.5, and then this. This is the covariance between the two. So that's really where we begin. We need to get the covariance between these. Now you see why I taught you to make the table calculations as well as using your calculator, and how to use Excel, because you will have to calculate this when combining assets. So this is new. We didn't do this yet, but the tools look similar than what we did before. In combining two random variables to create a new one, the new one is called P portfolio. This is the P for portfolio. When doing that, you cannot use your calculator unless you have a programmable calculator. So you have to use the other methods, right? Excel or the tables, you have to write them up in columns, etc. So this looks really menacing, but it shouldn't. It's just the covariance. So what is the covariance? We expect a negative, right? Because we saw that they were negatively correlated. Let's get that first and then go back to this formula. Let's get that first and then, so here is the space where you can calculate the covariance, and that's it. So in this space on your notes or on pages, calculate the covariance and prove to yourself after this class, because I'm not going to do it in class, you guys can do this yourself. You are going to find out that it's negative 0.0432. What did I just say? Negative 0.0432. Very small. And we don't exactly know what this number means, but we know it's negatively correlated. When one goes up, the other one goes down. To find out what it really means in terms of correlation, we would have to get standardize this, right? We would have to get the two standard deviations and standardize that. We have the two standard deviations, right? A's variance and B's variance. Let's do that. Let's calculate what would be the correlation. The correlation of A and B, remember, is covariance. This number here divided by the standard deviation of each of these. What I'll do is I'll just put them, let's see how good they are. Okay, I'll just put it in square root. I hope you guys know what I'm doing here. So I just want to get the correlation because that'll be easier to interpret. Although for my formula I don't need this, I just want to do this right now, show you. I'm curious. All right, so what is that? 0.0384 times 0.0486 square root on the bottom times 0.0432. Well, I get perfectly negatively correlated, right? Why does that happen? Anybody know why that happens? I only have 2 points. When you only have 2 points, you can make a line between them. There's no other point that's going to destroy your line. That will always happen. You only have 2 observations, so that's why that happened. That's right, 2 observations, or 2, I call them 2 values. There's only 2 values, 2 pairs of values. With 2 values, the correlation will always be -1, so remember that. It'll save you a lot of trouble. All right, so what I want you to do is to verify this calculation for homework. I'll just say do this to convince yourself you know how to get that. And let's use this, okay? So that's that. So we have that value. The rest of the values we have. Now I want to talk a moment, if you don't have any questions, where this formula comes from. The way that you consider several random variables at the same time is to use a matrix. Let me see where I'm going to do this. What we're going to do, I'm thinking of just maybe referring you to a video where I explain that. That's probably going to be better. Because this is going to be messy. All right, here's some space. So this odd-looking formula is telling you to make a matrix and consider the covariance of each variable in turn. So what I'm going to do is, what I had was x1 returns to asset 1. Oh no, I had A and B, right? Let's do A and B. A, and I'm going to do 2, but you guys can imagine how you can do 3, and the book explains how you can imagine 3 at a time and more at a time. So up here, I just put an X. I should have R in there. Anyway, don't worry, I'm sure none of it, that's not going to confuse you. Okay. So you build this matrix, and then you consider in turn 2 at a time. So what is the covariance of XA, RA with XA, RA? Does anybody know? And then what is covariance of XARA XBRB This, if you were to write it out, if you remember the formula for covariance, For sample covariance, it's easier if I write that one because I think students feel, well, I feel it's easier to explain here. So remember the covariance formula. For, let's say, for sample covariance. Covariance of XA RA with XA RA would be 1 over n minus 1 and then XARA, this is the important part, minus XARA bar, right? Because it's, I take the value, this is the deviation from the mean. I take the value and I minus off the mean. Now, XA, this weight, is being multiplied to every value, including the mean. So that's why that happens. And then, so once you see this inside the black box, you'll understand the result, okay? So this looks like this. Now someone tell me, oops, I forgot the RA. Now someone tell me what in the world this is and how I can simplify this. And the rest will fall into place. What is that? This XA is just a constant and it happens, look, everywhere. So can I just factor that out? So that's going to come out as XA, and there's 1 and 2 of them. And then it's going to leave what inside the bracket? I mean, on the summation. This is going to be 1 over n minus 1. Oops, I changed pages. Bear with me, everyone. What's left inside? Can someone tell me? If you've been following along. Anyone's here? What's left inside? What can you tell me? Simplify it. Okay, but what's... Yes, you're right. You're right. Very good. So let's write it so other people could see it. You're right. You are right. Oh, I did that wrong. Sorry. That's going to be inside. All that's left is RA minus RA bar and with a square on top. So this is like you've been saying in the chat. You see the chat? This is the variance. This is the variance. Yes, it's squared because there's 2 of them. 1 and 2. So it's squared. So this is just XA squared and var A squared, or var variance of R square. Okay? No, not square, sorry, variance of R. I don't need to square it. It's squared. But I could write it as XA squared standard deviation squared, right? It's S squared, right? Because var is S squared. So that was using the sample covariance formula that I think we're more comfortable with. The same result is here. This is going to become, well, I don't want to X it out, but this is going to become simply XA squared. Actually, you know what? I'm going to delete it. Let's delete it. This deleting becomes XA squared sigma A squared. So now it looks familiar. Sigma RA. Wait. I got to do sigma RA. It's RA squared. Okay. So that looks like, oh, just sigma A. It's just sigma A. I didn't use notation RA, but they're returns, so I'm just going to fix that. All right? All right, so we got the pattern there. Now, for people who didn't get it, please review the video, and I can give you a link where I make it look even prettier. I explained this to other students. So what would this one become over here? Okay, so what do you think what's gonna be left there? Okay, you know what? Let's do the easier one. The easier one is here. Down here, it's going to be XB squared, and then what? Sigma B squared. Okay, so what does that leave? It leaves this one, which will be cove XB RB XA Please let me know if you don't understand what I'm doing. And notice that these and these, or this and this, are the same thing. Do you agree those are the same thing? If you think about the formula just multiplies those two parts. So those two are the same thing. So I have two of them. And how do I write them? This, I'm going to erase it, is written as sigma, it'll be XA, XB, and you can prove to yourself why, and think back to the formula up here. If this was A and this one was a B instead, how this would work, XA, XB, sigma AB, which would be the covariance formula. And it would be the same here. This would be X, So these are all the portions of variation combining those two variables, the returns to A and the returns to B. And this is where the formula comes from. There's two of these, and then there's A and B's variance. Okay? So work with that. I'm sorry it's a little, like I explained at the beginning, I don't have Wi-Fi, so I can't use my iPad right now. All right. So, that's where the formula comes from. So now that I've explained where the formula comes from, and that this portion only happens if there's correlation. If that value is 0, this whole part drops out. This disappears. Okay? But for us, it doesn't, because we actually know they are negatively correlated. All right, so practice with that, those calculations. And the formula I've presented is just for 2, and that's all I'm going to expect on the test. However, theoretically, you could derive this formula for 3. All you have to do for 3 assets is add one more here, like X, C, R, C. And you would figure out the rest of the formula and the combinations. And it turns out that you just keep doing pairs. You consider the returns in pairs, A and B, A and C, and then B and C. That's what would happen. So we don't have to worry about that right now because we're going to stick with 2. So this formula for variance, you need to know how to calculate it. I'm not going to ask you to prove where it comes from, so at least put it on your formula sheet and know how to apply it, all right, for the test. Putting all of this together, the variance is this. Wow, is that ever small? When you take the standard deviation, wow, when you calculate the standard deviation, it's very small. This is the standard deviation of combining 50% of asset A and 50% of asset B, where both of them had high standard deviation, right? They were like 19 and 20%. So how did this happen? What happened is because of the negative correlation, you diversified your portfolio. And if you were to invest like this, you realize by putting these assets together, because they're negatively correlated, when one does badly, the other one is a hedge against the bad returns on the other. Okay, so that reduces your losses on average over time with a standard deviation of 1.22%. That's pretty stable portfolio. Questions? So I've shown you basically where the calculations come from. And the interpretation. So, what does it mean? It means that combining assets in a portfolio, the variances of combining them, the variance of the portfolio is less than holding these assets. If someone was to, or if a group of people were to be, if you looked at a group and they were holding a fraction of them were holding asset A and a fraction of them holding asset B, the group as a whole would only, their variance would become, without considering the covariance, 0.03. By holding these together, you can reduce the variance substantially. So this means that combining assets A and B into portfolio P, we eliminate some risk, mainly due to the covariance term. And it's brilliantly done in this one because, I mean, they're perfectly negatively correlated, and there are only two outcomes that I presented to you. So diversification is a strategy designed to reduce risk by spreading the portfolio across many investments. So now I'm going to distinguish between what you can diversify away, that's known as asset-specific risk or unique risk or unsystematic risk, and what you cannot diversify away. So meaning, somebody would say, well, just keep on adding securities, and you'll always be hedging against negative outcomes. But you can only do that so much. There's still market risk. That is how the market impacts returns on assets. And it'll impact them differently. Okay, that cannot be diversified away. So it turns out, in addressing the issue of how many assets to put in a portfolio, I mean, we did really well with 2, but how many assets to put in we 6.5% was our average return. To do better, maybe we want to add more, right? So financial economists looked at this question, and they didn't want to impose any other feature except random chance. What they did was take from a population of assets, they randomly selected assets to create portfolios of different sizes. So what they did is, first they just randomly selected an asset and then recorded, like in an Excel spreadsheet, the returns. So for n equals 1, let's say, they did this many times. Okay, and they recorded the return that they got. And so they could put this value here. So let's say the first asset had a 5% return, and then they did it again. They select one asset randomly. The next one they had a 10% return in that year. And the next one had a negative 2% return. And so they got the returns, and then they also got information on the standard deviations. Let's just use I'm having a heck of a time with this. So that's the return. And then they also got the standard deviation of returns. Okay, so they got information on the standard deviation. Maybe this was, I'm just making this up, 15. And then this one was the other security they got from another sample was 1. Let's say 11. and then the next one was five, and so on. Okay, so they did this for many securities. So let's say 25. I can't change it now. And what they did was they took the average of all of those tries. So I don't know how many they sampled, but they sampled several times. And then they got an average. It turned out that the average for doing one at a time was 49.2% standard deviation.
See ya.
Okay, so then that was for just choosing one at a time. Then they chose for 2 at a time, and 3 at a time, and 4 at a time. They chose for 10 at a time. Okay, choosing 10 at a time.
Did you like it?
I didn't have it yet.
Did you like it?
So for 10, you see the standard deviation calculated, taken 10 at a time, the average, and then the average of all of those different samples gave 23.9% annual standard deviation on average. For 20 at a time, it started to go down. Okay, so this is an example of diversification, that this is going down by adding more securities. But it looks like it plateaus. It plateaus at about 25 according to this paper, and in the text they talk about 20. Okay, so it plateaus at about 20-ish securities. You can't improve, if you're just randomly selecting, you can't improve the portfolio, reducing its risk any more beyond that. So what you need to take into consideration, and what portfolio managers or investors need to take into consideration, is this. What is this? It turns out that this is what we call non-diversifiable risk. This is the impact of the market, the relationship between the market and returns in general on all assets. So this is coming full circle to what we learned in the statistics review. What really matters, in addition to diversifying, okay, I have to say that because yes, you do reduce risk by diversifying, but only so much. What does matter in addition to that is how sensitive are returns to market changes. Now here in theory, we assume that diversification is costless and every investor can do it. They have perfect information to be able to do it. Okay, so diversifiable risk becomes irrelevant because everyone can diversify away. So investors should only care about systematic risk. So let's work with systematic risk. Okay. You can tell I'm in different surroundings today. Okay, so what do we do? So here's the data. This should look familiar. Here are the returns to security, returns to investors in BCE. It should look familiar. And these are returns to the market. Remember that we consider these where we plot this data. X is always the market and Y is always the asset. And I put them, now there's only 2 points. Remember, when there's 2 points, I don't have to use statistics. I can just use mathematics and calculate the slope. This is the slope. The slope is beta, remember. The beta measures the sensitivity of that asset to market returns or market volatility. So the slope turns out to be, or the beta turns out to be 2.5 positive. So this means that a 1% change in market returns will affect BCA with a change of 2.5% returns, which is great when the market is performing positively. But in a downturn, this is an amplified effect to BCE. Their returns are negative 2.5%. Okay, so that's it. Okay, so that's the slope. So I didn't have to use any of the fancy formulas. I just got to calculate change in Y over change in X to get the slope here, because they're just 2 points. So you guys can practice that. Then these formulas that we've already discussed. Okay, so the market portfolio we're going to define as a portfolio of all assets in the economy. This is in practice, we use a broad stock market index such as the S&P 500 to represent the market. Beta is the sensitivity of stock returns to the returns on the market portfolio. And all these formulas, you've already seen them. This is for when I give you ex-ante data, you should be able to calculate all of these things. Where the beta is the slope, remember? For historical data, we use B, R, SY over SX, risk. Where Y, we always plot the BCE or the security asset on the Y-axis, and the market on the X-axis. Another way to write that is with the covariance, and we derived this last class, covariance over variance would also give you the slope, where the correlation is the standardized covariance. So you saw these terms before. No, I'm not going to write it. So that's the standardized covariance. All right. What I'm going to do, because we only have a little bit of time, I'm not going to do Markowitz Portfolio Theory right now. I will do this after the test. So let's skip over that. And I just want, see, this is why I probably should have just given you this as extra. We're going to talk about that after the test, okay? Because this will go deeper. All I want to talk to you about right now is the capital asset pricing model and how to interpret the beta. And for all the things that I gave you, the Markowitz material is not important. It's just the background that you need to have, and I'll add some questions after this test. Okay, so the capital asset pricing model is used to price assets. Yep, what does that mean? Well, you will get that in a second. You probably learned this before. You should have learned this before. And that's why I want to go deeper into where it comes from next class or after the test, so that you have a greater depth of understanding, since this is the intermediate class. All right, so investors, as we described, should hold the risk-free asset and then they will hold a risky asset provided they are compensated by what? What is this? Can somebody tell me what that is? So don't get intimidated by the notation. You'll get the hang of it. There's lots of different notation used, but you should be able to interpret. This means the average return on the market portfolio minus the risk-free asset. So this is called the market. Actually, this is called the market risk premium. Okay? So the market risk premium, as I described before, is the little bit extra that investors require to invest in a risky asset. In this case, to invest in the market portfolio. That's the asset that I'm talking about. So they, for every unit of risk as measured by the beta for the asset, they would like to be compensated the market risk premium. That is the CAPM pricing formula. And what you get is the return, the expected return. This would be our, what we call, required rate of return for company I better make it lowercase. Okay, that's what we found. By doing this, we have adjusted for the risk inherent in the returns and found it using this understanding, this interpretation. So what have we done? Investors are only concerned with the return on the market portfolio that's expected and the standard deviation of market returns, and with the contribution of each security I to the market portfolio. M stands for the market portfolio. In terms of contribution of systematic risk measured by the beta and contribution of expected return. So, as I said, all investors should hold the market portfolio. So to invest, expected return, or the required rate of return to invest in asset I should be a markup above the risk for every unit of risk measured in the beta of asset I. Investors should be compensated by the market risk premium. And there it is. And I made some more calculations there. So here we have what we call the security market line. And I'm going to use this a lot. The security market line plots the risk-free rate here because the beta, remember this is T-bills as our example, right? So we say the beta of RF is 0 since it's risk-free, we assume that the sigma of RF is 0. So I will write things like all right, so that would go here. So that's the 4% or 3% or 2%, whatever T-bills return are. Right now they're 1%, negative percent, whatever it is, that would go on this line. Now you could go beyond this line, like with negative T-bill rates, or you could go beyond this line with negative, you could have a negative beta. Okay. So you could also have a negative beta, so you could go this way as well, or down. We also have here the return on the market portfolio. Its beta, so here's the market portfolio M, and its beta would be 1. Why is the beta of the market portfolio 1? Because what I'm saying, and you can make the calculations if you want. What does the beta mean? It's the sensitivity of market returns, of your returns or your asset returns to the market. But if you use the portfolio as the asset of interest, then you're saying the returns to the market portfolio as a result of the market portfolio returns. So it's 1 for 1, okay? So that's 1. And now we have created what's called the security market line. Now I'm going to ask you, if you're still awake, you're still with me, what is the slope of this line? What is the slope of the SML? Remember to refresh if things look blurry. The question is, what is the slope of the SML? Nobody? Excellent, Tiana's got it. So the slope of the SML is not beta. It's not the beta, okay? It is change in Y over change in X. The change in Y is this difference here, if I go from this point here to the market portfolio, then the change in y over change in x makes this the slope. Okay? Not beta. So what does it mean? It means for a 1 unit change in beta, investors must be compensated the market risk premium. Exactly what I was saying. So how do you use this? We use this to price assets. So we can figure out, and you should know this from 3106, you can, using this information, as long as you have the risk, you can find the return. So now you have a way to trace returns from risk and vice versa. So if you have the risk inherent in asset A, you can find the return. What you have to do is in this case, you have to take RF, which is 0.04, plus 0.08 times the risk premium. The risk premium is 10%. Now I always write things as decimals. I have a tendency but you could also write that as percentage. Remember, beta is not a percent, it's an index. Because R is an index, remember where the slope comes from. Sorry, I was going to say 4%. Okay? And that will give you the answer. So what I usually do is I simplify the market risk premium by taking these values together. Why write more than I have to? I always simplify the market risk premium by taking these together, and so that's 10% is the market risk premium, which you guys, we did that today. You subtract the asset, or in this case the market portfolio, minus the risk-free. So you get 4.8%, right? Sorry, it was 0.8, not 0.08. And then you get 12% or 0.12. And then you can do the same thing down here. Didn't copy. I'll just rewrite it. So 0.04 plus, in this case, 1.2. So it's more sensitive than A times 0.1, 0.1 or 0.10. And that's going to equal 16%. Higher risk, higher return. So we're using that property. So like I said, after the test, I'll get more into the derivation of this. Any questions? So that's the capital asset pricing model. Now, if I want to combine them in a portfolio having 60% in A and 40% in B, I make a weighted average, and I calculate also a weighted beta. Isn't that neat? So these are all results of the fact that we use the coordinate space of return and risk marked as we see here. This is our return, and this is our risk. Okay? Okay? Okay. So you could plot those on the security market line. I could plot A, and I could plot B. I'll just use this space here. So if I the beta of A was here, right, at 0.8, and the beta of B was here at 1.2. Beta of B is here at 1.2. That means that the return on A will end up lower than the return on B, because that's where it traces through the line. So the expected return on A will be here, around here. Oh, I use big A. I'm going to change that if I can. It's okay, I'll just use a capital. No changes allowed. I can use lowercase or uppercase, and then the expected return on B would be higher. Because it would be here. So everything traces through the security market line. And what else can I tell you? Oh, I have to tell you, what if securities are off the line? What if there's a security that's down here? Then it would be the case that investors are getting this over here for this level of risk. Now, presuming, in theory, we assume investors have perfect information, they have all the information, they know how to use the information. All right, so they would be aware of this security market line and all the other assets. And they would look at this and say, for this level of risk, I should be getting this level of return right up here. They should be getting this level of return according to the security market line, the assumptions we've made. So investors in that security, what they would do is sell the security, okay? They give it away, even the price would be falling. To clear the market or to adjust, the price would be falling on the asset. What happens when the price falls on an asset like a stock that's valued by the formula that we use, right? We use C1 over, now we're going to call it, well, we were writing it with a perpetuity given the assumptions we were using with an I, but now I'm going to write it as C1 over the expected return, because that's what we've done. We found the appropriate risk-adjusted rate of return to use. And what I'm saying is the price will fall. If a security is off the line, below the line, the price will fall. And if everything else was to stay the same, or if to maintain the same level of returns, dividends, as constant, the expected return should rise. Okay? So the expected return will rise, the price will fall, and put the security here. So it's properly pricing the asset by the market would put it back in equilibrium, we say on the security market line. So assets below the line are called overvalued, and the price must fall. And investors, when stock are overvalued, I'm just going to go over a little bit with this. When stock are overvalued, what do? They short them. We'll talk about this more after the test. What shorting is. If you don't know it, you should know. Okay, when stock are overvalued, they should borrow it through a broker, and then they can sell it, use the proceeds for whatever they want. They can invest it in the market portfolio, for instance. And then later, when they have to return the asset, they can buy it back at a reduced price because the price fell, you see. What if an asset is above the line? I'll mark it with I call that X, I'll call this J. What if an asset exists above the line, a security? What is the adjustment process? I'm going to clean this up. If there's an asset that exists above the line, then for this level of risk, investors are getting a really high rate of return, aren't they? This is what is expected by the market, but investors up here at J are getting an exceptionally high return. So what's going to happen is investors who don't own J want to own J, and they're going to offer higher and higher prices for J to acquire it. So they're going to bid up the price of J. What happens in our market with our valuation formula? The price of stock equals the dividend, right? Present value of future cash flows, where we call this expected return now. This price is going to go up, so that's going to simultaneously let the expected return go down. So this is why we talk about this being the capital asset pricing model. Okay, it helps us price by knowing the expected return, and effectively we know the price. Okay, so the price will adjust because price and expected return are inversely related. The expected return will drop, and that's why it will fall in the line. So assets above the line, the security market line, are undervalued. Their prices are too low. Undervalued securities should be bought and held to realize the profit, because they're cheap relative to the price that they're going to go up to. So you should long these assets. So hopefully this is just a review for you, because you should have learned this. If not, review these notes and my discussion. I'll put a link to a video on that, how to calculate the variance of the portfolio. I'm not going to I shouldn't say it's prettier, because I think that's when I had my old iPad and it was even messier. So you're probably going to do fine with this explication. If you sit down and you make the matrix yourself, make it pretty in different colors, you'll see what I'm trying to say, all right? Sorry that I don't have Wi-Fi. And next class, we don't have a class next week, but I will have Wi-Fi again. It's just today, right? Any questions? So I'll send you, I don't know, I think all that stuff I sent you, I could test you on, because the Markowitz stuff, I'm just adding, that Markowitz stuff is not, it's just like a backgrounder to why everything is happening. But I'm going to leave everything from page 20 to '31 omit for now, okay? 20 to 31 for the test. But all those other handouts I gave you, you should be able to solve them. I gave you all the answers. You have everything. Let me know if you have any questions. I don't want to say omit, because we're going to postpone pages 20 to 31 till after the test. Okay, let me see if you have any comments. I'll leave this up. Okay, I'm going to go through the questions. So Janesha asked, do we have to do graphs? Probably. I drew the graph, so you should know the graph. Okay? You're going to have all your notes in front of you, so if you mess up the graphs, I don't know why. You shouldn't mess them up. You should just follow along what I do there. You should be able to do the graphs. Von Mighty was asking about what I was doing. Okay, so yeah, so Von Mighty, is your question answered by my explanation? Let me know. So Ricardo, the test grades from I'm sorry, everything is delayed. Yeah, the test grades you should get after the weekend, so you'll have them before the test for test 2. Sorry about that delay. So really what we spent time doing on statistics, I'm really depending on you having understood that, because it seems like I zoomed through the notes, but you really should know that stuff. It's just a matter of sitting down and calculating everything yourself and not being intimidated by the notations. Okay, good. Okay, so we are free for the weekend. Please keep me posted if you have any questions. All that material is just a bunch of review questions. The test questions will be like those. So study them, know them, and don't, I know I'm giving you a lot of time for the test, but don't count on all that time. You know, you want to be confident. So take this week to review exercises, and please keep me posted if you have any questions, or if you want office hours, I can join you for office hours online. Oh, I hope you have a beautiful weekend too, all of you. Okay, have a restful weekend, refreshing weekend, revitalizing for the week ahead. We have holiday, so that should be great. So try and work a little bit each day, and then we'll be in touch on Sunday or Saturday if I don't hear from you. I will send you the test at 9 a.m. and you will have till Sunday at 3. That's what I said, right? I'll check my emails to make sure. Buen fin de semana.